Good morning, trading world. It is August 18th, 2022, 7:59 a.m. on the East Coast, and this is my pre-market outlook and technical analysis for day trading the SPY. Had a little fun with the title this morning. F it, Skew you. Before I get into it, where did volume go? Coming into this morning, it looks like it just dried up again. Now, one thing that I've noticed is that Skew has really picked up the last few weeks. Most retail traders have no idea what Skew is. Volatility skew, as defined by Investopedia, is the difference in implied volatility between out of the money options, at the money options, and in the money options. And again, most people don't know why this measurement is important, but the clue that Skew gives is when it reaches levels above 130, it's that a lot of hedging activity is starting to take place. A majority of all investment strategies are still long only. So what do you do when you have gains in a long only portfolio if you're expecting a drop in the market? You either take profits or hedge. Taking profits seems to be a lost art, or greed has started making people hold on way too long, but I digress. Most hedging strategies involve buying out of the money options. This is why we look at Skew to give us this clue in the puzzle. Let me bring a chart up of Skew. And Skew is an end of day data point. So here we go. As you can see, Skew has been relatively low, which kind of makes it suck for my premium selling strategies that I do. But it's starting to pick up again. As you can see, we came very close to that 130 level here. Now, I know you see this way up above, way super high up here, but we have to kind of ignore that because it's a one-off. It's because of how the Fed kind of juiced and let loose all this extra money in the market. So the Fed kind of acted as a put, so no one really, we got to levels where people would normally hedge, and we kept staying in those levels, and people kept hedging and kept hedging, but all the while the Fed, with all this new money and easy money, kept things in the area where we should have failed long before. So you have to kind of ignore all of this because this is Fed induced up here. But now that we're kind of back to a normal, somewhat normal mode in the market, I expect us to get to this 130 area, and this is usually where, when you have Skew above 130 and you have back month VIX starting to move higher, this is where most people start to expect a pullback of at least 5 to 10% in the market. So we can see right here clearly with the skew chart hedging activity. I mentioned two things. When you're in a long-only portfolio, you can do two things to protect it. You either take profits or you hedge. Now, it's simple to see profit taking. You can just add a money flow to whatever product you're tracking. Let me do that to the SPY right now. And here we have a 1 year daily chart on the SPY. We have a money flow down below. Let's pick that up a bit. All right. And as you can see, anything above the zero line means money is coming into the product. But below the zero line, money is actually leaving the product. And as you can see, since January, more money has left the SPY than flowing into it. And there's also something to be said about the divergence here. We have higher prices, and yet still money is being taken out or kind of evened off, but still negative when it comes to the inflows. So that's not really a good sign for bulls in the market. Now, there are two ways to see this. This is definitely an easy way to kind of get a visual of it. There's also another way. There's a website called ETF.com that tracks a lot of the inflows and outflows of a majority of the big ETFs. And as you can see here on the 16th, when it was last updated, you can see it was very negative. So we can see that money is still flowing out. And you can do this with pretty much any stock that you're tracking, or through this website, any ETF. And that's pretty much it. That's my diatribe for the morning. So with that being done, I hope you get something from this. I hope this helps. Let's get into the key levels to watch for the day. All right, here we are with the key levels of the day. Starting on the resistance side, we have our jack resistance at the 428 to the 429 area. Queen resistance, we have it at the 430 to the 431 area. This 430 is going to be really important today. Figuring we would kind of reject from there at some point today. And then we have the king resistance level 432 to the 435 area. And I'm looking at that 433, which will probably be pertinent for Friday's level, in getting there or getting through that level. On the support side, we have our jack support at 426 to the 425 area. Queen support, we have it at 424 to the 423 area. And then king support, we have 422 all the way down to the 419 area. All right, the main thesis for today is bearish. closing below the 426.65 with a projected target low of between 426 and 422. The alternate thesis is bullish, closing above the 426.65 with a projected target high of between 428 and 434. The current major channel we are in is 425 all the way up to 453. Something to keep in the back of your mind. We started the week at 427.1 with an expected move upper edge of 434 and lower edge of 419. We are basically in the same place we started. Out of a plus or minus 7.6 point expected move, we have over 4 points still left in the adjusted expected move for the last 2 days of the week. That should tell you to hold on to your chair. There's a lot of movement to happen over the next 2 days. With that, let's get to the scenarios of the day. All right, our most probable scenario for today is going to be our expanded range day structure. We could look to set a decision area high boundary around the jack or queen resistance area before chopping back lower on the day. And that lower is going to take some time because we are going to see the baton handed off through a lot of time frames at some point today. It's going to take its time here, chopping down, and actually you'll probably see that this 426 area, it's going to be the place that we want to wind up today. But don't be surprised if at some point, after coming back and testing it a couple times, to see us break through it and kind of get a little spill out and then try to come back to it and then close out the day, possibly rejecting it. So that's our expanded range day structure. That's how I see things playing out today for that day type. Alright, our next scenario is our rounded reversal day type structure. We could get a continued push lower off the cash open toward the jack or queen support area. Give me just a moment to correct that. Alright, excuse me. Alright, now that that's corrected, we could get a continued push lower toward the jack or queen support area, and then find our midday chop around either the queen or king support area, before spending the same energy we used coming down to go back up the second half of the day. That's our rounded reversal day type structure. There is a vice versa warning on our rounded reversal day type structure. And that warning or vice versa warning would go like this. We could start up on the cash open, which is highly likely today depending on how the jobs number comes out, and find our midday chop around either the possible queen, we would say the jack or queen resistance area, and then start the second half of the day with a fade that has the same amount of force as we went up with during the first half of the day. So that's our vice versa warning on the rounded reversal day type structure. Alright, our last scenario of the day is our trend day up, which means we open gap up, start with a fade back toward the previous close represented by the blue line, We find support on or before that previous close, then begin the uptrend for the morning, also known as our golden window. We find midday chop around either the possible queen or king resistance area. And today, watch out for what could be a deep fade in the second half or right at the close of today. So that's our trend day up. We also have a vice versa alert because of the jobs number and where it could take us. But if the vice versa takes effect, this is what you would be looking at. We would have a pretty bad effect from the jobs number that would take us to a point where we would gap down. Cash open comes and we would start a pop back toward the previous close, but find our resistance on or before that previous close. And then we would have our major trend or our golden window down, taking us toward either our possible queen or king support area. We find midday chop there and get a head fake down to start the second half of the day. And we would get a lot of chop the second half of the day, trying to make it back up. But it's going to be very hard, and we could find ourselves kind of fading lower after the close or into the close. So that's our vice versa warning on our trend day type structure. I hope that all of this helps. I really appreciate the feedback that people saying they really learned a lot or this is helping them. I really enjoy that. But again, your most important job as a trader is to protect the capital that you already have. And we do that by knowing and understanding our risk and managing that risk in accordance to our account size. I'm going to close out this morning's pre-market as I do always, wishing you a positive trading day. Have a great one.